Last week, we talked about how rising bond yields were starting to garner the attention of investors. And apparently, we weren't the only one paying attention. On Wednesday of last week, Treasury Secretary Scott Bessent announced plans to increase the Treasury Department's purchases of longer term Treasury bonds in hopes that it would help stem some of the recent rise in yields. Probably not a coincidence that on the very same day, the Treasury made a separate announcement that the national debt had surpassed 40 trillion for the first time. I'll spare you the details of how the Treasury's buyback program actually works, but in short, the Treasury doubled the size of its liquidity support purchases from $2 billion to $4 billion. And the expanded program is scheduled to run from September 9th through November 4th. And in total, the Treasury is expected to purchase roughly $20 billion of longer-term Treasury securities. One important distinction here, this is not quantitative easing. The Treasury isn't creating new money to buy bonds the way that the Federal Reserve would. Instead, it's essentially funding these purchases by issuing more short-term Treasury bills. So, in very simple terms, the government is retiring some longer-term debt and replacing it with shorter-term debt. And bond investors originally liked the news, and Treasury prices rallied and yields moved lower. And the problem is it didn't last very long. I think there are a couple of reasons for that. First, while 20 billion sounds like a big number, it's really a drop in the bucket when you compare it with the more than $32 trillion of government debt held by the public. I think the announcement was probably more important for its signal than for the actual dollars involved. Secretary Bessent is essentially telling the bond market, we're paying attention to yields, and if they move materially higher, we have the tools that we're willing to use. And that may help put something of a ceiling on yields in the near term, but ultimately we'll have to see. The fact that the initial rally in bonds reversed so quickly suggests that investors aren't entirely convinced. The bigger issue is that none of this really addresses the structural forces that have been pushing longer-term interest rates higher in the first place. And we talked about several of those last week. You have the continued lack of discipline in Washington and the enormous amount of debt that the government needs to issue just to finance the annual deficits of close to $2 trillion. And then you have the inflation concerns. Inflation measures have run above the Fed's 2% target for more than 5 years now. And getting inflation back to target is likely going to remain difficult given the ongoing energy disruption in the Middle East and recent tariff announcements between the US and Canada. And finally, there's simply more competition for investors' money. Yields overseas have become more attractive, while at the same time, we're seeing significant bond issuance from AI-related companies as they raise enormous amounts of capital to fund data centers and other infrastructure. So while the Treasury can influence the supply of longer-term bonds around the margins, it can't make those underlying issues disappear. Which brings us to what I think will be the biggest event for markets this week. It's Fed Chairman Kevin Warsh's speech at the annual Jackson Hole Economic Symposium on Friday. And this is an important opportunity for Chairman Warsh. If he wants to restore some confidence into the bond market and potentially create a more sustainable decline in Treasury yields, I think investors need to hear something more concrete about his inflation-fighting resolve. Specifically, markets want a better understanding of what they call the Fed's reaction function. In other words, what would actually cause the Fed to act and raise rates? Is it headline inflation reaching a certain level? Is it core inflation, inflation expectations, wage growth, some combination of those things? Markets don't necessarily need an exact formula, but they do need a better sense of what policymakers are watching for. There was an interesting Financial Times article recently that analyzed the language Chairman Warsh tends to use compared with his predecessors. What stood out is that he tends to focus much more on words related to process than on specific economic data points. That actually makes sense for somebody who has talked so much about changing the Fed's operating regime and the way monetary policy is conducted. But right now, I think the market needs something a little more concrete to go on. Maybe Chairman Warsh is right. Maybe investors got spoiled by years of forward guidance when Fed officials seemingly told markets exactly what they were thinking and what they plan to do next. But forcing investors to go cold turkey from that level of communication has proven to be a difficult transition. And that's why this Friday's speech matters. The Treasury has now shown that it's paying attention to higher long-term rates. And this week, investors will be looking to see whether the Fed can give them greater confidence that inflation and ultimately the forces pushing those rates higher will remain under control. We'll be watching that closely, and we'll look forward to providing you with an update next week. I'll see you then.